Good morning, everyone. Welcome to the webinar, Plan Design Help During Uncertainty. My name is Bonnie Treichel, and I am a principal with ZUNA. We are a registered investment advisory firm in Portland, Oregon, and we also provide consulting services that help with strategy around your business. I'm super excited to have the folks from Leading Retirement Solutions here with me today to present and to speak with you about some of these really critical business decisions that you're making right now. I have Kirsten Curry here with me today, as well as Jean Skonetski, and I don't think I messed that up, but I'll let Jean pipe in if I did. So I'm really excited to have their expertise here with me to share with you a little bit on the plan administration and record keeping side as we go through these issues. So a couple of just quick housekeeping matters before we get started today. If you have any trouble with the sound or the quality of being able to see the slides as we go along, please be sure to contact info@teamzuna.com. Once again, contact info@teamzuna.com and someone will get back to you right away to help you access everything. Also, be sure to relax and just listen along, because after the presentation, we will send out the slides as well as a recording, and also you'll have an opportunity to click a link and schedule time to speak with Kirsten as well as myself on a one-on-one, as we'll take you through your specific plan and how these provisions and items apply to you specifically. So you can get the general idea on the call today, and then we can have a follow-up with you to go through each of these items and how it applies to your specific plan. So be on the lookout for that later today or first thing tomorrow. The other couple of housekeeping items to keep in mind is that your lines are muted. So if you want to make any comments or questions at any time, be sure to use the question and answer pane in the right-hand side of your screen, and we'll be able to take a look at the questions that you are asking throughout, and we'll be able to see who's asking the question and we can get back to you. So feel free to leave any comments that might be helpful for us to be able to answer your specific questions related to the needs of you and your business. So we'll go ahead and just flip on through. We've got some bio information at the beginning. That'll let you know that we're qualified to actually talk to you on these topics. So what are we going to talk to you about today? We'll spend most of our time going over two main points. The first is that we're going to talk to you about what you're hearing all kinds of information about, which is the CARES Act. So we'll talk about how the CARES Act is really meant, as it relates to retirement plans, to address the needs of your employees and how your employees can get access to their funds in the retirement plan if you determine that you're going to adopt certain plan provisions. So we'll spend time today talking about really two main ways through these distribution options as well as expanded loan options that you could adopt as an employer to make these additional funds available to your employees. What you want to keep in mind is that the CARES Act doesn't really do anything to help employers to ease their burden or their obligations. The CARES Act really, in the retirement plan context, is really all about your employees. So we'll spend some time talking about other ways to think strategically as it relates to the business, and we'll jump into that momentarily. The second thing we'll talk about in the retirement plan context is, outside of the CARES Act, other plan design considerations that you can be taking to actually think about how you can help ease some of the burden for you as an employer, and how you can do other things to help your employees potentially access funds in the retirement plan. So we'll really have those two main areas that we'll cover: the CARES Act and then other ways that you can be reviewing your plan to make plan document changes. So what is the CARES Act? By now you've probably received hundreds and hundreds of emails about what the CARES Act is, and you're probably wondering, where do I even start? Do I start in the health and welfare side? Do I start in how, if I'm a small business under 500 employees, I can take advantage of the Paycheck Protection Act or part of it? There's so many different aspects. We're going to focus on the retirement plan side today and really drill into the expansion of loans, the distribution option, the change with respect to required minimum distributions, and that one little quirky thing that I found to be quirky anyways, which is the expansion of the student loan provision just for 2020 itself. So with that, I'm going to turn it over to the next presenter, and Kirsten's going to go through kind of, as a business owner, how you might start to actually break this down and think about it and apply not only the CARES Act, but other retirement plan design provisions and thoughts for your business.
Great. Thanks so much, Bonnie. It is great to see everybody on the webinar today. I have to tell you, as of Friday and the enactment of the CARES Act, the retirement plan industry has really kicked into overdrive. And I know for many of you business owners and leaders, same things potentially happening on your side with employees, whether they're still with you or terminated, asking for help getting access to their retirement monies. Presumably as a fellow business, owner and leader, I'm constantly evaluating my company's priorities, and presumably many of you on the line have been doing that in the midst of these significant times. You've probably done financial forecasting, you've reprioritized the company priorities, and are well in the midst of trying to figure out, what to do next for the company. And so one of the common questions we get is, how do I decide if I should make changes to my company sponsored retirement plan, particularly in light of the current environment? So we're hoping to help you better understand how you can make those decisions today. Oftentimes, eliminating a company retirement plan like a 401k or a 403b plan can be one of the things that are top of mind. But I would submit that doesn't tend to be the best decision. In some cases, it could ultimately be. What's interesting is that, particularly with 401k and 403b plans, there's a significant amount of flexibility. And so oftentimes the conversations and the decisions that are made by companies are really around making changes to the retirement plan to fit the changing needs of the company, the new normal of the company during these significant times. Things like ceasing certain benefits, like company contributions, are considered. Utilizing the CARE Act flexibility. You're going to learn a lot about that today to help your employees get greater access to their retirement monies. Freezing a retirement plan are all considerations. Something that's important for our plan sponsors and leaders to understand is that if you decide to ultimately terminate your company-sponsored retirement plan, there are some rules and restrictions related to that, some more long-term repercussions. There's what we refer to as a 12-month rule, where if you terminate a 401k plan, the company cannot start up a new one within the same 12-month period. So these are all important things to consider when you're making your informed decisions about what to do with respect to your retirement plan. Finally, and most importantly, talk to your service providers. We want and need to understand your changed priorities, your changed goals, your changed financial needs. We can all, make some assumptions about where each of our clients and business owners are today, but communicating to us really helps us provide you with information so you can make informed decisions about what to do. With that being said, I'm going to turn the webinar over to one of my team members, Jean, to talk about additional plan operation considerations as you look to make decisions about your company-sponsored retirement plan. Jean, go ahead and take it away.
Thank you, Kirsten. And so I'm the client service manager with Leading Retirement Solutions, as you saw in the bio, and my main job has to do with working with plan sponsors in designing their plans and operating them as it goes through time and things may change. I just wanted to take a few minutes to discuss some high-level considerations regarding how your plan is operating now and how it potentially should change in in the coming months, depending on how your business is impacted by the different changes or restrictions. Want to start off with what's the same, what hasn't changed. Generally, you have your payrolls, participants make contributions, and those have to be banked. That hasn't changed from the standpoint of the Department of Labor and those deadlines. So your payroll processing, the deposit deadlines of the 7 business day or as soon as practicable, those still exist and should be done. Many of you are probably engaged right now in your 2019 plan year administration, giving reports, doing testing, and that sort of thing. Those deadlines have not changed. The reporting for the Form 5500 is still due on July 31st, could be extended until October as usual. And it may be that the Department of Labor will give sort of a blanket extension. They've been given the authority through the CARES Act to make these types of decisions and issue that guidance, but we haven't heard anything from them on that yet. Also, participant notices for fee disclosures, annual notice or other summaries from the plan from 2019 will still be due on those deadlines, so be prepared for those notices to go out. You're going to probably see more transactions come up than you have before. Certainly one of the highlights of this webinar and the focus of the CARES Act is to make some retirement dollars available for employees and participants as they go through and manage their own finances from, maybe their business, maybe their layoffs, or maybe their shortened work time. So be prepared. First off, make sure that participants have access to their online accounts. Not all participants, I can tell you as a provider, actually have logged into their accounts historically over time. So be prepared to have those notifications ready for them. Loans are going to be requested, whether that be online or in paper form, depending on your plan. Distributions will be pushed through. So there will be more activity on those lines. Definitely be prepared to provide access to those forms and processing those internally to the record keeper on the plan. On the next slide, I want to go into some other considerations about plans as a whole. Generally, the business interruptions like this are an interruption of revenue flow, and depending on how much revenue or how much interruption a company is experiencing, they make decisions whether to make certain changes to plans. If I can get the next slide, that would be great. If you're looking at there's really no one solution fits all in this scenario, because something may be as easy as your workflow it needs another couple of weeks or needs another little bit of time to start making some deposits that you normally make. So understand what the contribution deadlines are for your plans, and it may just be that you need more time instead of making a significant change to your plans. If it comes down to making significant changes, it will really depend on the type of plan you have and how it's configured. On this slide, I'm going into, I just want to describe some different types of plans as a whole, instead of getting into some of the specific details of how changes are made, just sort of some of the considerations on how you make a decision on which direction you might run. Safe harbor plans are normally a commitment starting at the beginning of the year. They eliminate certain more restrictive tests that you might be subject to and give owners and highly compensated more freedoms and contributions. The Department of Labor and IRS like to see that commitment carried out through the year, and making changes to those is a bit like turning a large boat. They're not real slow, and you don't always come back from them. So, for safe harbor plans, the changes generally aren't made mid-year except for some severe circumstances like revenue loss for the company, or it can be done more easily if you've delivered a notice or a disclosure in the annual notice that says you're reserving the option to make those changes. Review your annual notice, review your document to see what's available to you. and connect with your service provider to see if that's the right thing to do. One thing about safe harbor contributions, and I'll go into that a bit more in detail on the next slide, but you're making yourself, you're losing your exception to some of the more restrictive testing, like testing of 401k contributions, which could trigger refunds, or top-heavy considerations, which could trigger required contributions from the employer to the plan. And so there may be some outcomes with trying to seize the safe harbor and stop the contributions mid-year that may cause things that you cause even more financial obligation. Discretionary plans with discretionary contributions, generally you can make a change at any time. Double check your plan document to see what's allowed. Typically, it's best to stay in touch with participants, employees about these changes, even when there's not required notifications from the plan. Company memo letting them know what's going on with the type of change that you're anticipating, and potentially when it might change back and contributions resume. If your plan has discretionary contributions or non-discretionary, some of those are written into the plan, but still can be changed mid-year without notification. Many of those don't eliminate other tests. You're still subject to them, and so it's just a matter of changing that in the plan document. It will probably be an amendment, and then being subject to the test with the reduced contributions. And then speaking specifically, next slide please, on safe harbor plans. There are special considerations regarding the safe harbor, stopping a safe harbor. I generally find that if a plan or a company is going to cease a safe harbor earlier in the year, provides more opportunities or provides a little bit less obligation on certain things. Certainly if you wait until later in the year, third quarter or later, then you've already made significant contributions and other factors apply, so that it may just not be the best answer to cease it versus just continue it through the year. But just take a look from the standpoint of what solution will fit you. Is cancellation the best answer? Maybe delaying contribution deposits for long enough so that cash flow from any business reduction catches up. For instance, if your plan has a matching safe harbor where you deposit the match on a payroll basis and allocate it there, it's not required that those matches are deposited with every pay period. You actually have until the end of the calendar quarter following the quarter that the pay period appears in to make that contribution. If the match is allocated after the end of the year, then you have until the tax filing deadline of the year following. So it may be that the deposit's not due for the match until next year in April, or even as late as September. So take those in mind when you're considering any significant changes in plans. The CARES Act, as I mentioned, expands the authority of the Department of Labor to eliminate certain requirements on notices and other things. They haven't said anything just yet. And what it really means to you is that changes that you want to make to your plans now are really going to follow the established rules in ERISA, the ones that you're already familiar with or may have looked at before. By the same token, testing any changes that one may want to make to plans for the previous year, for 2019, there's nothing that's come out about that. And so anything along those lines would have to be something new coming out from the government, from the Department of Labor or IRS, making some exceptions. And then, as I mentioned earlier, realize that when you change a safe harbor or when you eliminate those restrictive tests, you will be subject to testing of 401k contributions, which could result in refunds. Not such a bad thing if you're looking at just receiving dollars back from the plan that you contributed, but one of your bigger concerns may be the top-heavy rule, wherein if your plan is top-heavy and you would be subject to making a 3% contribution to all employees anyway, if any of the key employees had made contributions. And being at the end of March, it's probably the case that these key employees have made contributions, so you might have already committed yourself to a 3% contribution in that right. And typically a matching contribution can be less expensive in a plan than a top heavy. So those are definitely things to get some projections on. On the next slide, I've got a little bit of detail to give about defined benefit plans. If one has a defined benefit plan, then realize that the market downturn that you saw earlier this year really won't affect the calculations for your 2019 contributions. What you've already been given as a contribution range will stand because the valuation is generally calculated based on the investment accounts as of the end of 2019. So those numbers will pretty well stay the same. As far as the year coming up, review the valuation that you've already got from your actuary. Many times there's comments about the year to come, the contributions that will be required in the next year should certain contributions be made for 2019. That could give some information there. One of the good things that came out of the CARES Act is if as a company you need more time to make the contribution that you're being asked to do for 2019, you're being given until January 1st, 2021. Now, I've seen that happen once before in one of the disaster acts, one of the hurricanes that hit Florida, and another where they extended the September 15th contribution deadline for defined benefit all the way until the end of the year. So realize you have at least that, and if you do that, there will be a little bit of consideration on how much that's going to be. It'll have to be recalculated, but that's probably not going to be significant. If the business interruption is even more severe and you're looking at will I be able to make these contributions or will I be able to provide these benefits in the future, it's possible to do a freeze of the benefits in a defined benefit or cash balance plan, and in that way you'll be not obligating or not creating more liability in the plan to fund for benefits, although you'll still have to make up funding percentages based on earnings. So it would significantly reduce contributions, although not necessarily limit the demand. But there again, look at your valuation, because it may be that your funding is enough ahead that you wouldn't need a contribution. Now, if one is going to look at a reduction or a freeze like that, defined benefit or cash balance plan typically have an accrual period of 1,000 hours worked in a plan year. And for a full-time employee, they normally cross 1,000 hours somewhere in the month of June. Certainly by the end of June, it's there. So right now there's just a good window of time to consider this and get some plan in place to make a freeze of benefits if you're looking at it. There's a 15-day notice required. So figure that by the 1st of May, that notice being given out and the freeze being put in place. And there again, one of the opportunities with the freeze is that it can be frozen for an indefinite period of years, and then when it's unfrozen, you can always restore some of the benefits that were not given during those years. As far as terminating a defined benefit or cash balance plan, it's a pretty significant consideration, especially because a plan may not be able to be terminated if its funding is not sufficient. A defined benefit plan has to be able to cover all of the liabilities or fund all of the benefits that are accrued in the plan before it can terminate. So it may be that the plan has to be frozen for a year or more in order to bring the funding up to date, and then terminate after that. So those are all considerations to take in mind. Our team is ready to have those discussions, and if you've got whoever your provider is or your actuary, definitely get in touch with them on those considerations. And for the next slide, I believe I turn it over to Bonnie.
Great, thanks, Jean. So one of the things we've been covering so far is taking a look at the employer side of things. So we've been looking at how employers can make shifts on their contributions. So now we're going to shift gears and think a little bit more about the employee side. So looking first at traditional methods or your current methods pre-CARES Act of how employees can access their money in the retirement plan. And in a moment, I'm going to turn it over to Kirsten, and then she's going to shift gears and talk more about under the CARES Act, how these traditional methods will shift. But first, let's just talk about, without the CARES Act, if you have employees who need to access funds in the retirement plan, how could they do that under your current plan document? Or alternatively, how could you get together either the settlors, or rather, when we say settlors, what we're talking about is your business owners. So those who can make decisions on behalf of the business, how could they say, we're concerned about our employees having access to funds in the retirement plan. How can we help them to expand those options, either with what's already available in the plan or making immediate plan document changes to expand those options. So we'll talk a little bit about that right now. And when I think about it, there's really 5 ways that employees can access money in the retirement plan. And before we jump into those 5 ways, I want to point out, in no way am I saying, or on behalf of my colleagues, am I saying that we are encouraging people to access funds in the retirement plan if they don't need to. I think in our update that we published, I described it as, this is a last resort option. We're certainly not encouraging people to go out and take out loans or take out hardships. We can certainly talk about that in a one-on-one setting, or later in another slide I'll talk about a little bit of the fiduciary considerations, but we want to view these as last resorts. We certainly don't want to update the loan policy to start being unlimited loans. We want to look at this as, what are really the needs of the participants in the plan, and then adopt changes accordingly. So kind of back to, what are the 5 options in which participants can get money from the plan? The one that's not on the screen and is a pretty obvious one, so maybe I don't even need to state it, is they could have a terminating event. And on the next slide, Kirsten's going to talk a little bit about terminating events, and she's going to talk about the difference between furloughs and layoffs and what those implications are when you're making some of those decisions. But back on this prior slide, slide 11, we'll focus on kind of 4 other ways outside of someone leaving the company. So leaving the company, that's option number 1 of how someone can get money. The second one would be through loans. And what we'll talk about under the CARES Act is that loans are expanded, but one of the things the CARES Act doesn't do, it expands the amount, but it doesn't expand the number of loans that are available. So one of the things that you'll want to be thinking about is, if you have a loan policy that says the number of loans outstanding can only be 1 loan at a time, it's up to you as an organization to figure out, do we want to expand that? Do we want to allow 2 outstanding loans or 3 outstanding loans at a time? One consideration will be making sure that your service provider or record keeper can handle that updated policy should you decide to adopt it. And then second, it's really just for the settlers to decide, is that a path we want to go down by expanding that? Does that really meet the needs of our participants? And one way you could start to assess that is just by running a report of all of the current loans that are outstanding and looking at the needs, and then making some additional determinations. So number 1, loans. Look at your current policy with respect to the number of outstanding loans, and that'll be a starting point. And then in a moment, you'll talk about with Kirsten how the CARES Act actually expands the amount that's available for loans. So the next way to access funds in the retirement plan is through hardships. And again, one thing we want to keep in mind for all of these provisions I'm talking about right now is that you have to think about, yes, these are available plan provisions, but does our plan actually allow for them? And you've really got to dig into your actual document to look at, do we actually allow for these things, and what are the details of that? So for hardships, for example, you have to take a look at, do we actually allow hardships, and what are the provisions of that? And then Kirsten will talk about here in a moment how there's additional types of distributions under the CARES Act, which are very distinct from hardships, because we want to keep in mind with hardships that there is a 10% penalty associated with that. So that's the third way. So we have terminating event, loans, hardships, and then the next way to access funds for your participants would be if you have in-service distributions at 59.5. And I think many plans have this option, but I've seen some plans where that's not available. So that would be another way that you could make funds available by making an immediate plan amendment change that would open up those funds for those who are over 59.5 in the retirement plan. And then the final way we'll point out is through the source of rollovers. So if someone has rolled over funds into the plan, making sure that you have it in your plan document such that those funds could then be rolled back out to that individual participant. So again, check your plan document and see, is that an available option for those individuals who might have that source available? And if not, again, that could be an immediate plan document change that you could make today to start to make some of those sources more available. One thing I'll point out before I turn it over to Kirsten to talk a little bit more about kind of those terminating events or around the difference between furloughs and layoffs and some of those issues is just when you're making these plan document changes, a couple tips to keep in mind. First and foremost, you want to make sure the right people are making these decisions. So again, going back to that comment I made a moment ago of, is it a settler decision or a fiduciary decision? And we know things like loans, for example, hardships, or whether we're going to have that as a provision in the plan. Those are going to be settler decisions. So those, for example, your CFO likely has the authority as a settler to act on behalf of the business. You wouldn't have to convene a big fiduciary committee meeting to make that decision. So keep in mind who's allowed to make those decisions. Second, definitely document when you're making these decisions, who's making them, and make sure that's documented. The third thing I would keep in mind is, I think Kirsten made the point earlier, communicate with your service providers. You want to really be communicating. We want to hear from you, your record keeper, they want to hear from you. So definitely don't just make a change to your loan provisions and increase the number, but never tell anyone else. That will have a negative result. So definitely communicate that back to your service providers. And then finally, again, I know you're already doing so much to communicate with your employees, but definitely make sure you're communicating this back to employees as you're making these changes. And I think that's one place where I know we're doing a lot to work with our clients to help them put this into more of a comprehensive communication strategy. Don't just send out kind of the one-off email about the retirement plan that's going to get lost, but make sure you're working it into a more comprehensive strategy that goes along with your health and welfare plans and other benefits so that it can be a really cohesive communication strategy back to employees. So with that, I'll go ahead and turn it over to Kirsten to continue on with the next part of the presentation.
Great, thank you, Bonnie. As business owners and leaders, many of you are probably looking for ways to help your employees. And particularly financially. And of course, many of you are on this call because you're trying to understand how you can do that through your company-sponsored retirement plan. One of the really important kind of threshold matters in making that consideration is, the type of termination when you're looking at terminating versus not terminating employees and how it may affect their employee benefits. The type of termination of an employee does affect a plan participant's ability to access monies from their retirement accounts. And we're going to spend a little bit of time talking about that now. A severance of employment is really, in the retirement plan industry, what we consider a termination. It tends to be a facts and circumstances analysis. When you lay off an employee, it's generally considered a severance of employment. When you furlough an employee, it may not and likely is not considered a severance of employment. And why is this important? Well, if you don't have a severance of employment, participants, there's going to be effects when it comes to the retirement plan and the retirement accounts, and we're going to talk a little bit more about that. There's been a lot of different creative kind of ways of terminating employees and laying them off and furloughing that I've been seeing over the last number of weeks. And so this is something really important for plan sponsors to be talking to their service providers as they're, making considerations about what to do with employees. Now, if there's a severance of employment, a termination, a bona fide termination of employment, what are a couple of the effects? Well, there's a distributable event for retirement plan participants. And this means generally that a retirement plan participant can take their money out of the retirement plan unfettered, fully vested account balances, of course. Now there could be a downside to a severance of employment for a retirement plan participant. Depending on how the retirement plan is designed, it may accelerate the due date of a participant's outstanding loan. And so again here, as you are continuing to consider, keeping employees, letting them go, making sure that you're reaching out to your retirement plan providers and understanding how your decisions may impact your participants' abilities to get money in and out of their account. Now, if there's no severance of employment, and a typical example of this again is if you furlough employees with the intent of bringing them back to operations sometime in the near future, participants will generally still have access to the traditional kind of in-service distributions, the ones that Bonnie described, loans, hardship withdrawals, in-service distributions, and also rollover amounts, all depending on how your retirement plan is designed. We're going to talk here in a little bit about how the CARES Act has really expanded the ability and opportunity for employees to get more money potentially out of their retirement accounts. Now, as a reminder, and I mentioned this earlier, depending on how many employees you actually sever from employment, you may be looking at what we call a partial plan termination. And I bring this up again because it tends to get overlooked as a potential effect of letting employees go, and just understanding that one of the main effects is that company contributions become 100% vested. All right, so as I mentioned a bit ago, we're now going to spend time talking about the CARES Act and the additional flexibility it provides to employees who are trying to get access to the retirement monies. So let's talk about that expanded relief and go ahead and move to the next slide. All right. So there are a couple of main ways that the CARE Act has expanded employees' access to their own retirement funds. And the first way is what we call kind of a COVID-related distribution. It is akin to a hardship withdrawal. Folks are also calling it a hardship withdrawal with expanded relief, whatever you want to call it at this point. It is a distribution that is allowed to be taken by employees while still employed. And then the second way that the CARES Act has expanded employee access is with the expansion of a participant loan program. So let's spend some time doing a deeper dive into both of those opportunities. Most importantly about both of these options and the CARES Act relief is that the plan sponsor has to authorize and agree to this relief. Right? It's at the plan sponsor level where the company needs to decide we are going to add these features and allow these features by way of our company retirement plan. Now, you don't have to amend your retirement plan documents first. We were granted some relief there, thankfully. That can come later down the road, but the threshold is really making the decision that you're going to allow this expanded relief. All right. In order for a plan participant to qualify for the expanded CARES Act relief, they have to be considered a qualified individual. What does that mean? Your plan participant is somebody that was diagnosed or has been diagnosed with COVID. They have a spouse or dependent that's been diagnosed, or they've experienced adverse financial consequences. Whether it be furlough, reduced hours, unable to work due to childcare, and other examples. All right, let's move to the next slide and get further into the details about both of these programs. And let's start by talking about that kind of that in-service distribution or the hardship withdrawal with expanded relief. So a few additional requirements. One, we already talked about how the company, the plan sponsor, needs to make the decision to offer this relief to all plan participants, you've got to be a qualified individual, qualified plan participant. You know, you've been diagnosed with COVID or have any of those other reasons. Also, the distribution, the expanded hardship distribution must be taken during 2020. So we anticipate that post 12/31, a participant will not be able to take advantage of this particular relief item. The expanded distribution allows an employee to take up to $100,000 out of their retirement account balance. And then there's a number of additional features that go above and beyond your traditional hardship withdrawal program. This type of in-service distribution is exempt from the 10% early withdrawal penalty. A participant may also waive the 20% withholding requirement that's typical of a hardship withdrawal program. The participant, and this is a big one, may repay the monies back into the retirement plan or another qualified retirement account in the future. Now, there are some specifics around that. You've got a 3-year period to do it, and there's some other requirements, but that's a pretty significant one because that would ultimately allow, if a participant were able to repay up to $100,000, it means that there would not be that income tax impact ultimately. All right, and then again, as a reminder, this relief expires by 12/31, so this kind of distribution needs to be requested during this calendar year. Okay, now let's spend a little bit of time talking about the expanded participant loan program under the CARES Act. How did the CARES Act expand your traditional participant loan program? Well, it did this in a number of ways. First off, it increased the amount of a participant loan available to participants to the lesser of $100,000 or 100% of a participant's vested account balance, or $10,000, whichever is greater. This we anticipate will be helpful to participants, but we also anticipate that with this new threshold of $100,000, we will see business owners being able to tap into a participant loan from their own accounts to help with the business. Again, here, some criteria. The participant needs to be COVID eligible, diagnosed with COVID, family member, and the like. A new loan must be taken within 180 days from March 27th, which was the enactment of the Act. And for any existing participant loans that are in effect now, there's some relief there also. Keep in mind, this expanded relief doesn't change the retirement plan's loan policy. So, you know, if your loan policy says that a participant can take out 1 loan or 2 loans, those still apply. Nothing's changed with respect to that. A few other benefits and features with the expanded participant loan program. For any existing and outstanding loans, a participant can request a 1-year delay in loan repayments. Interest will continue to accrue, but the duration of the loan will be extended for at least 1 year. Again, remember that the plan sponsor needs to agree to adopt this expanded relief. This program, accessing and utilizing this program, does expire at the end of the year as well. Also, one other thing to keep in mind, if an employee is terminated, there's a severance of employment. Most retirement plan documents generally require that a loan be repaid in full. So that's something to take a look at. Are there changes that you want to make there? And then also be aware and cognizant of how you report employees to your plan service providers. If you are actually terminating an employee versus furloughing, it's important that you're careful about how you're reporting those employees to your payroll provider, your retirement plan record keeper, and even your third-party administrator, so that we've got the right information to perform calculations and provide you with guidance. All right. A lot there. As service providers in the industry, we are all very busy right now making changes to our systems and our standard operating protocols to really accommodate this new expanded relief. And with that being said, I'm going to go ahead and turn the webinar back over to Jean to talk about plan amendments.
Thank you, Kirsten. So there's many changes that are being enacted right now through different legislation. Understand that the very basis of a retirement plan is that it's a document signed and which creates a law for the company related to the taxation of these contributions. Everything sort of devolves down to, well, if it's written in that way, then that's what you can do. And this doesn't change in times like this when exceptions are being made or enacted by Congress. Eventually, all of this has to become part of the written document of the plan so that you've got some reliance that what you did was according to the document provisions. So the question comes up here, when do I need to act? At what point do I need to ink these changes and sign the execution pages? And that really is going to depend on the types of change that you're looking to do. On this slide here, we've sort of detailed a few of the different actions, and I want to call your attention to the little ladder diagram here. Bonnie put that in at the last minute. It's a brilliant piece. It's sort of a scale of when you need to act now versus when you can let something slide a little bit. Now, if you're looking to make a change to the obligation contributions in the plan, I mentioned earlier, if you're looking to freeze the plan benefits for a defined benefit or cash balance, if you're looking to cease the safe harbor, you're going to have to pick up the phone and get in touch with your retirement provider now and start making those changes, because generally those have to be signed. Those amendments have to be signed before that change takes place. And if depending on what it is, you may want to get that done as early in the year as possible. On the next phase, some of them you'll have to do or can do by the end of the year, meaning December 31st, 2020. And those would apply to things that you're trying to change. Say you've got a fixed contribution on matching, but it's discretionary, it's not a safe harbor, then and you want to make a change to that, you have to make that before such discretionary changes before the end of the plan year that they apply to. So some of these changes you've got until the end of 2020 and being able to actually act on them at this point. If you'll remember last year, the Secure Act came out near the end of the year in December and gave a number of changes. Some of those changes you may want to look into at this point. One of them comes to mind, which is a penalty-free distribution for covering birth or adoption expenses. That's part of that particular act, and maybe you've got someone who's covered in that's not necessarily covered in some other way. Those amendments are generally need to be adopted into a plan by the end of next year, by the end of 2021. The actions that you're looking at now coming down from the CARES Act, you're free to enact them, to make the changes operationally, and to do those things. Be sure to record them, be in touch with your provider, your document provider on what changes you've made, and generally you have until about the end of 2022 to actually ink those changes into plan documents. Some amendments can be made retroactively. If you're looking at changing something to make it more liberal in the plan, open it up for something, or increase contributions, that can be done retroactively, and that may cover a select set of situations here. And from a practical consideration, you're making changes to something that you've already promised as a benefit offering to your employees, or that's already ingrained in the company culture. Be in touch with your employees. Some of these require notices to employees, others do not. They certainly want to know if there's some change coming down in something that the company has done by discretion. So company memos on changes, what the change is, what to predict from it, or the duration of such a change helps keep a more stable environment there. And with that,
Perfect.
I believe we're into the next slide here.
Great. Thanks, Jean, for covering kind of that operational aspect of how to get these changes into your plan. Next, we're going to cover a little bit of the just hodgepodge of other things that made their way into the CARES Act. So I want to quickly hit on a couple of those items. The first you'll note that made its way into the CARES Act relates to student loan provisions. So for those of you who remember the Abbott Labs letter with the IRS that gave them the ability specific to Abbott Laboratories to pay back student loans on behalf of their employees and do that as a part of the retirement plan, there's now that opportunity for employers for all of 2020, but that's only for 2020 at this point unless that gets extended later. So that made its way into the CARES Act for any employers who want to take advantage of that. Another aspect of the CARES Act relates to required minimum distributions, or RMDs. So we've heard a lot about RMDs this year if you took a look at the Secure Act, and now it's coming up in the CARES Act. So as it relates to the CARES Act, during 2020 only, RMDs from plans and IRAs are delayed for 1 year. So for during 2020 only. Now the question might be coming up, what if I've already taken an RMD during 2020? So there is a 60-day look back period where if you've already taken an RMD, then you do have the ability to pay that RMD back just for the prior 60 days. Another aspect I wanted to just briefly touch on relates to health savings accounts. So although this is more on the health and welfare side, I just wanted to briefly touch on it given the nature of how health savings accounts come up in the retirement plan context, as many of your employees likely use health savings accounts as retirement vehicles. So briefly touch on that HSAs were expanded under the CARES Act, and they were expanded such that they allow for payment of over-the-counter medication and menstrual care products. So that's probably coming up as something for your employees to know about if you have a high deductible health plan with an HSA, and then also that does extend to FSAs as well. One other just plan design consideration for the educational aspect for your employees that you may want to be thinking about. So this is totally unrelated to the CARES Act, but just given that we've talked about plan design considerations, if you do have a plan that allows for Roth, you might want to be providing a little bit of education or a reminder to employees that this would potentially be a time where some education around Roth conversions could be a good opportunity. So some of your employees might want to take advantage of that at this time where we've had some market downturn. So a few other things to point out, and I'll go ahead and just flip on to the next slide, where I know we have a lot of employers on the line who actually wrote in with questions in advance related to the market's down, what should I be doing? So I wanted to briefly address just two considerations as it relates to the market downturn in light of COVID. So one that I wanted to point out is that if you are working on a pending record keeper transition that would involve a blackout period, we would recommend some sort of consideration in conjunction, obviously communicating extensively with the record keepers on both sides of that transition, that you consider if now is the appropriate time for a blackout period. Given that money would be out of the market, given the volatility, I think obviously you have to weigh the pros and cons of fiduciary issues of why you're making that transition and the timing around it, but certainly a good time to have that conversation and give that some thought. The other thing I wanted to just point out is the plan sponsor's role as it relates to providing education or information in times of market downturns. Certainly, the HR office is getting questions of potentially panicked participants. Hey, I just saw my account, it went down 30%, what do I do? And I think it's great to have a reminder that as the employer or plan sponsor, your role is not to provide advice. Your role is to make available the requisite information to comply with 404C, but your role is not to be giving advice. And I'd love to have a conversation a little bit more about how you can do that. We have some FAQs that can be made available that help to position that. And then, of course, relying on your service providers. Many of the record keepers have those who give advice or education, and then pointing your individual participants that direction can be really helpful so that you're not in that role. So with that, I know we've got a couple other questions that we really want to be able to touch on to round that out, and then we'll just leave you with some action items.
Thank you, Bonnie. Just a couple of points here. As employees are being are coming and going, so to speak, for different business reasons, how do you handle something like severance pay? Severance pay here is defined as compensation that you would give to an employee, not for work that they actually perform for the company, but to help tide them over after they're terminated. The IRS generally allows that compensation that a person earns through service to the company, whether it be hourly, salary, vacation pay, sick pay, those types of things. That's the pay that would apply for planned contributions. That's what they could contribute to their 401k, and those would be the amounts that you would match. Anything that you give a person in consideration of, buffering the fact that they had to be terminated or they had to leave is not qualified for them to contribute generally, and you're not obligated to make matching contributions or other types of planned contributions based on that. So be sure to check the definition of compensation in your document to see exactly how it applies, but generally you can feel free to give some severance pay and not necessarily be obligated heavily in the plan for that. And then the next consideration is look to the future and how this is going to shake out as the business gets going again and things get back to normal. You may want to make some considerations on your plan for as it gets back up and running. For instance, if you've got a significant layoff from your workforce, as you hire employees back in, you're going to basically ramp up the contributions and obligations to the plan. Maybe you want to look at changing eligibility to the point where you can space out how long it takes for new employees to become eligible in the plan and the company to be obligated to those contributions again. Certainly there's a consideration for plans that have trustee-directed valuations. With the market downturn right now, that could mean that a person would be distributed based on a valuation from 2019, and there's not the same value in the trust. Generally, plans like that are allowed to amend themselves to do a valuation in the middle of the year so that all account balances are brought into line with the current overall value of the assets. Definitely get in touch with your provider on that.
Great, and Jean, I'll hit cybersecurity really quick because we're looking to wrap up the webinar at the top of the hour. Several points on cybersecurity. I'm going to hit on one. Distribution fraud is only going to continue to increase, especially with many more employees and participants working from home. Make sure that your retirement plan, your authorized contacts are up to date with your retirement plan service providers, all the way down to contact info, especially as you may be looking to let people that are responsible for the day-to-day administration of your company retirement plan, if they're working remotely or on layoff or furlough with you. So just make sure that all contact information is up to date with your service providers. And Bonnie, we're going to go ahead and turn it back over to you to close things out.
Great. Well, thank you so much to our friends and partners at Leading Retirement Solutions for joining us today. On the next slide, we have just a culmination of action items. Hopefully those who attended can take a look at the action items, and then as a follow-up, you will receive a set of today's slides, the recording so that you can listen again for anything you might have missed, and then an opportunity to click a link and meet with Kirsten and myself so that we can go over one-on-one with you how all the things we talked about today apply to your plan, and then hit any questions from the question and answer pane that we might not have made it to today. So we really look forward to going over these action items on the final slides and staying in touch with you to help you through not only the CARES Act, but as it was mentioned a few times today, it is highly, highly likely that we will have a lot of additional guidance coming from the Department of Labor, as they did get that expanded authority under the CARES Act. So I think we'll see a lot more to come, particularly on relief for the employer side of things. So thank you again for all your time today. We really look forward to keeping in touch with you, and take care, everyone.
Great. Thank you.